Hi, and welcome to this chit chat, which I'll be having with Amit Goenka, CMD of Nisus Finance. The reason why we are having this chat is Nisus Finance is coming out with an IPO on the BSE SME. I found this IPO quite interesting, so I've come here to get more information on the IPO so that all of you can decide whether you would like to apply or not. Welcome, Amit.
Thank you, Amrish.
Uh,
Appreciate your time.
Thank you. Uh, you've been in the real estate industry for a very long time. What made you start Nisus? And I think recently you celebrated your 10 years at
That's
Nisus.
right.
Yeah. So if you just throw some light on the journey
Right.
and what made you get into this?
So, being a financial services professional for over 12 years, I think there was in my mind, a tectonic shift in the landscape that had to happen for urban infrastructure with the Press Note 2 of 2005. I saw that as a huge opportunity for India, backed by FDI capital, enabled by this press note, to take global capital and institutionalize itself and create truly world class infrastructure with high governance, which needs not just capital but also professional acumen as well as a framework for becoming globally competitive. We already saw IT industry, automotive industry, and several sectors becoming institutional in nature and becoming global in scale. I saw that as an opportunity for India in the real estate and urban infra space as well. And that's really when I transitioned first as Knight Frank, then as SL Finance, and finally setting up Nisus Finance in 2013. We realized that it is upon us to take Bharat to the world, to take Bharat to markets, and to make our urban spaces livable and global in nature, so that when we look at growing India, we look at Viksit Bharat, we look at a resilient and reliant India, it has to be on the backbone of our infrastructure and our living cities. So for me, this was a huge opportunity set to apply my financial services domain to the real estate and infra space.
So what is it that you did so differently that you stood out?
I think first was to find out where the opportunity set lied, rather than looking at it from a very high level, four city, five city, major player domain.
Right.
I realized that India thrives in its villages, in the to be urban locations, and that's really where the growth story has to explode. So not only, of course, are we present in Mumbai, Pune, Bangalore, Hyderabad, Chennai, and NCR, but we are present also in Ahmedabad, Surat, Indore, and growing into multiple emerging metros of India.
So basically, you're looking at the mass market.
Absolutely,
Okay.
absolutely. I'm looking at the demographics of India and saying what is it that India or Bharat needs to be able to urbanize itself. So, A, we're present pan India. I think that's one big differentiator. Second, we focus on SMEs and not only on the large corporates. The large corporates obviously have a very clear growth trajectory built for them.
Right.
But clearly, 70% of the market is SMEs, which is really creating grassroots level infra. That's really again where our focus lies.
That's where the demand is.
Absolutely. So these are the creators, these are the demand creators, this is where the demand lies, and our focus continues to be on them. So these two differentiators of being pan India, focusing on grassroots and SME has been our biggest differentiator for us.
So when did you start your first fund? I think currently you're handling about 1,000 crores?
Yes, absolutely, absolutely.
So if you
As of
just,
March 24, we were at 1,000 plus crores. So our first fund, of course, started in 2014 with the first 500 crore offering.
Right.
Each fund is roughly about 5 years, so it lasted till 2019.
But was it the wrong time to start a fund?
It was the worst time potentially. It was potentially the worst time.
Because
but
I think there's still 17, nothing moved as far as the real estate was
absolutely
concerned.
right,
Yeah.
absolutely right. So we've come out in terms of trial by fire, and come out still unscathed, but very very hardened and seasoned in what can go wrong. So we understand what can go wrong. But yes, it was a tough time. There was a spate of capital which was maybe unreasonable as well. There was a spate of developers which were ungoverned and not corporate enough.
Because
And
this was pre-RERA.
absolutely pre-RERA, pre-GST, pre-IBC,
Absolutely.
pre-demonetization, everything was happening. There was exuberance in capital markets, but there was a lot of flux, and there was irrational lending happening or irrational capital allocation, which created a lot of disruption.
How much did you raise that time?
So, we've deployed roughly about 400 crore rupees between 2013, 14 and 2019, by multiple transactions.
And how much did you return back?
We've returned 2x of that. We doubled
okay.
our money in about 4 years.
Mm-hmm.
Doubled our money. So because we are very careful, we are very
Right.
clearly curating our transactions,
Mm-hmm.
investing carefully, not looking to blow out our AUM and get blown in the process.
Mm-hmm.
So we don't, we did not have any issues with our portfolio, despite the market having exploded with a lot of NPAs, with a lot of challenges, with
Right.
many institutions, NBFCs effectively becoming bankrupt or
Mm-hmm.
turning belly up. We did really well because
Mm-hmm.
we were very careful. We kept our book tight. We kept it very curated. Took very specific opportunity with the right people who were underbanked but had the right framework
Mm-hmm.
to do what it took.
Okay.
And so that's why by targeting those people by the right opportunities, I think we did okay.
So currently you are at about 1,000 crores AUM. Uh, Out of the funds raised, you plan to put about 35 crores for fundraise for your.
Absolutely, absolutely.
Yeah. So I mean, what sort of AUM you are looking at with this?
So obviously we are able to now more than double our AUM going forward with
Mm-hmm.
this new capital injection, which is the reason why we're in the market,
Right.
is because obviously today our capex is our client acquisition cost,
Right.
and that really for any insurance, mutual fund or us has to be client acquisition. Once our investor comes on board, we've seen effectively none of them leave. They keep
Mm-hmm.
on re-upping their commitments from fund to fund,
Mm-hmm.
and they effectively stay with us forever and bring their own friends and family. So clearly, now that we're looking to grow from 1,000 crore of March 24 to potentially more than 2x of that in this financial year,
Okay.
and obviously 4x of that in the next financial year. So clearly, to do that, we're able to obviously put this money to work, give it to the distribution companies
Mm-hmm.
who are bringing their global clients and the
Okay.
largest family office institutions in India to join our various fund pools, and that
Mm-hmm.
will obviously allow us to deploy that
And
capital and double and
and for
triple.
you, I think geography is not a limitation.
Absolutely right.
Yeah,
Absolutely right.
because you're there in Dubai.
Yes.
So can you just give us more idea on what's happening? One, the Indian markets, Mumbai, Bangalore, and all the
Yes.
main markets in India,
Yes.
and what is that opportunity of seeing in Dubai?
Okay, very heavy question, but let's look at India first and
Yeah.
Mumbai and key markets. So today we're on the cusp of a huge infrastructure boom. We're seeing metro, we're seeing coastal roads, we're seeing connectivity with the entire Bharatmala road
Right.
network. We're seeing port developments, we're seeing new airport developments. So the urbanization that is happening in Mumbai alone and MMR as a whole is absolutely explosive.
Mm-hmm.
Today we've seen suburban locations come out which are hard to access, which people are able to now access it in a much shorter time frame
Right.
and actually still be in the city or
Mm-hmm.
work in the city. So there's a huge amount of suburban development, and that effectively expands across asset classes.
Right.
We have seen a growth in warehousing, data centers, hospitality, healthcare, retail, office spaces, grade A office
So basically,
spaces.
for every rupee spent by the government on infra, how much is spent on?
In our estimate, it is at least 20 times of that goes
Okay.
into urbanization of a micro market.
Mm-hmm.
So one airport with $1 creates 20 bucks of related urban infra,
Mm-hmm.
covering housing, workspaces, retail, and entertainment
And that's
spaces.
your market.
Absolutely
Okay.
right. That's my
Okay.
market. So
Mm-hmm.
we've looked at Malad. We're looking at extension of Marway, Mud Island, which is all connected with the coastal road. Prabha Devi, for example. We have
Mm-hmm.
metro coming right into Prabha Devi.
Mm-hmm. Mm-hmm.
So today with that connectivity, you see the number of redevelopments that are coming only Lower Parel, Worli, Prabha Devi area,
Right.
which is possible because of connectivity. So today, even a middle class can afford to or look to afford to stay in a location like Prabha Devi, Lower Parel, which is where we see the new demographic change
Mm-hmm. Mm-hmm.
in these micro markets. So I think a huge opportunity in Mumbai, same in Bangalore, same in NCR as a whole.
Right.
If you see the kind of road networks that have come at NCR today, you can travel effectively from Delhi to Mathura in a matter of less than an hour.
Right.
So the connectivity is absolutely
So
extraordinary.
you're there, what, across about 18, 20 markets in India?
See, we are currently invested in about 10, and
Okay.
we're looking to at least double the network
Mm-hmm.
or our presence across 20 at least cities within the next 12 to 18 months,
Okay.
and grow from there, because we do see a 30 city opportunity immediately,
Mm-hmm.
and potentially 50 cities in the next few years where we can be present. We can support the SME developments with our capital pools.
But do you think 2,000, 2,500 crores will be enough?
No, it is not enough. It's not enough. No, but then again, for India, the total outlay will be at least about 4.5 to 5,000 crores over the
Okay.
next 2.5, 3 years.
And what about Dubai?
And Dubai again is a very unique opportunity because again, like we've been anti-fragile in India. We've done really well during COVID. In fact, we started our business, or we started doing these products right after the GFC of 2008. That's when I started really inventing private credit. And we've seen that any black swan event or any sort of any tectonic shift in normal leads to a huge amount of opportunity set. So clearly UAE and GCC is today an anti-fragile location.
Right.
Any global disruption tends to lead to migration and flow of capital and people, and not just any people. Today the most successful business houses, the most successful financial services are looking to move to that, away from areas of disruption, and set up their base and grow their base from there. So we saw that as an opportunity, having worked India markets for the last 10-15 years. We saw that there's a natural extension for us to actually take these products and services to the UAE and actually start investing in the region.
So can I say that you're an early bird in UAE?
I am definitely a disruptor and an early mover advantage in the UAE for sure. I'm also potentially one of the first ones who have a gift city pooling vehicle which can take OPI investments into UAE markets and other GCC markets and actually cause investments in those cities of Indian money through the gift city route. So it's an official channel for people to invest dollar money into those emerging markets and make a huge multiple on that.
Right.
And again, potentially.
So that's already floated.
Yes. We established Gift City last year. We started operations. We've established DIFC. We started operations. We already bought close to $50 million of assets in the UAE, and we're looking to make a very large amount of multiple and returns on that. And we're being joined by global banks. We're being joined by global investors there. We've got significant support from local banks who are willing to lend on our investments. So yes, a very strong ecosystem is getting created in the UAE for ourselves.
But all this time we've only been talking of the fund management part of your business. I think you have another large business which is basically advisory and transaction.
That's right.
So can you just throw some light on that?
No, certainly, Amrish. See, what we realized is that when we look at Bharat, and since we started, effectively, I believe India real estate is not more than 10-15 years old since the dawn of the 2005 press note.
Right.
And again, honestly, the counter got reset post 2008 GFC. It, I think, again got reset in 2013-14 with a lot of the mayhem that happened. So effectively, in my sense, real institutional capital really started to come the last 10 years, and that's how REITs formed, that's how large FDI funds came in the country, that's why large shops got created and multi-billion dollar books got created.
Right.
So we're still at a very infancy stage in our cycle. Right. So obviously, when you do that, you're looking at now the SME segment, which wants to access that capital, which wants to access capital through us, global capital, but does not have the necessary infrastructure or framework to do that. They don't understand beyond the product. How do they access that capital? So that's really when transactions. So we realize that money is not the only plug. It needs to be able to assist investee companies to actually reach that level.
But then there is no conflict of interest?
No, there is none, because our first endeavor is to make companies capital ready. Capital comes second.
Okay.
So once they become capital ready, where they say, okay, let's partner, let's create joint ventures, let's divest non-core holdings, because legacy investments, obviously they're not working. Land banking doesn't work as a strategy anymore. Right. It used to be a multiplier in the past. So when we start looking at inbound demand, and we see almost 500 plus trades a year, not everybody can take our capital. Maybe 15-20 trades will take our capital. But the balance 450, 470 people are still seekers of solution.
Right.
So that's really when we realize that we're leaving them on the hook. So let's bring them on the fore. Let's try and use our relationship. We're at the center of the India urban infrastructure ecosystem with partnering. We partner with the largest institutions who co-invest with us. We partner with the largest consultants. We partner with the largest developers. We partner with government agencies. Now that kind of an ecosystem that exists in our favor, let's make that available to those balance 450, 470 people who are not able to get a capital on the first go.
Right.
Because they will need a larger JV partner to come in and help them grow from 1 million to 10 million square feet. It's not a natural extension of their journey. Go into multiple asset classes, create world-class products, not the standard templatized that they've been doing 20 years ago. So when we start creating those solutions, there's no conflict, because we're starting first in some of these cases which are non-fundable to make them fundable ready.
Okay.
When they become fundable ready, then they have an option of either coming to us or going to the world. Many times they will actually go to another NBFC and say, okay, we've solved for this. We are now ready. We look very, very institutional. We've got the right partnership. We've paid down our debt. We monetized non-core assets. We're sitting on so much cash. Now you partner with us. Become very, very credible and fundable. Right. So many times they will effectively go with us to another funding partner who will be love to have a trade like that, because it's already curated now through our teams. many times they will still want to take our capital for the short term, saying the solution is great, but you need to solve for the short term.
So you're giving bridge and then
absolutely. So many transactions of ours took bridge from us, loaded the TDR, got the joint venture, cleaned up the issues, got in a partner, made it absolutely packageable, and then went to an NBFC and says, okay, 12% money, 5 years, fantastic.
So in fact, revenue-wise, you are earning more from your advisory business as compared to the fund.
And I think it makes logical sense also.
So I mean, where is the focus now going ahead?
See, focus has to be capital, because capital is the backbone of development. But capital has to be not just capital like through a bank, because we're not a bank. It has to be solution-oriented capital. So I think it's an intrinsic play between services and capital. But capital still has to be the backbone of our business. So even if we are putting in 5,000 crores of capital, we should be able to service 50,000 crores worth of demand. So that's really where the interplay happens. Because otherwise we are stuck in a 220 model, and that is not value addition. That is only capital providing. So there's no difference between a bank and an NBFC and a private provider like ourselves, who are at the center of the ecosystem and understand the space backwards.
No, but tell me, I mean, you're talking such large figures. Why SME? Why not the main board?
It was a tough question, Amrish, and I struggled with that for almost 4 months in taking a call whether to go to the main board or to go to the SME board. But if we finally took a call to go to the SME, of course, at a discount on the valuation or whatever the norms for the SME board are, largely for 3 reasons. The first is, we've always been in alpha provider on returns, and our fund obviously is a very clear example of how we have differentiated our results from our peers. We are one of the highest Sharpe ratios as a fund manager. We're rated excellent by Care Edge Ratings. We have been rated as one of the top performers by Prequin. So when we do such things in our funds, we have to obviously translate that for our larger stakeholders. So I realized that by doing that, we'll be able to provide a hopefully much better return in the small exchange, because we're looking to come at a discount as opposed to the main board standard valuations, and that means that our investors hopefully will make significant capital or significant gains from our performance. So I think that was one driver. The second, of course, is the fact that we are already over-regulated. We've got SEBI with multiple funds, we've got IFSC in GIFT City, we've got DIFC in Dubai, we've got RBI and an NBFC. So we've got significant compliances going on. Now, should we divert our attention from our business and those compliances to actually do main board compliances and take away the bandwidth, take away the focus from business to market? I said, we don't want to take away a focus from business to market. Let us focus on business. Let us grow. Let us become the biggest boys in the country, which the market will benefit from, rather than focusing on markets. Let the markets earn. Let us grow that journey with the growth capital that we're seeking from the markets. So I think that was a very significant reason as to why we didn't go forth with that. And honestly, again, we don't need the kind of money that we would have to go and raise in the main board. We don't need 200 crore rupees. We don't need 250 crore rupees. So what is the need? When you take excessive capital, you tend to burn cash. We've been very frugal with cash. We've been bootstrapped for 10 years. Whatever investors who came in have also exited with very large multiples and have been bought back by me at fair valuation. So it's very critical that we are very frugal with our money. We behave like a bootstrapped company for the rest of our lives. Therefore, we had to raise only enough money to be able to grow a business 5 times or 10 times without getting flush with unnecessary liquidity or taking money home. Otherwise, I'd do an offer for sale, take money home and say, okay, now let the market see what to do. That is not the intent. We're at the cusp of growth. We are today catering to Bharat story. Today we are creating to a 2047, to a Amrit Kal story of 2047. Today we are catering to a Sakshat Bharat story. So when we are catering to the story, we are actually at the cusp of growth. We're at infancy stage, honestly, still. We have to chart the adulthood story as we become the 3rd largest economy in the world.
So you believe you have left enough on the table for that investor?
Much to my chagrin, but yes, I think I've given what all I could have. My entire family wealth is in this business. I don't take money home. We don't create extraordinary amount of goods into our families. Idea is to service the company, is to make the company grow, is to create a social impact for the stakeholders and to create a large wealth for our stakeholders over the next 10 to 15 years. And obviously that will always remain the objective. It's not an enriching story, it's an impact story.
Thanks, Amit, for being very frank with all your answers and answering all my queries which I had. I hope this is useful for the viewers and will help you to decide whether you need to apply for this IPO or not. and be a part of the journey going ahead.
Thank you.